Hello, welcome to today's webinar. My name is Brian Ladd. I'm a principal broker over at Cascade Sotheby's, and we've got a really timely topic to talk about today. It's been an absolute wild ride in real estate the last few years, and it feels like we're on a roller coaster of emotions and activity and pricing. But we feel that we're in a slight shift that's happening in the market. And I think it's a healthy shift. And we're going to talk about how that's happening, what data points we're seeing, and then how to operate within that environment as we see it. So we've got a lot of fun things to talk about today. It looks like a lot of people are just logging in now. Thank you for joining us. At the end of this, we'll send out a link to everybody so they can rewatch it if they find it interesting, and they can also forward it to people that weren't able to join us today. But before I get started, I want to introduce the two people that I have joining us today. We've got Stephanie Higgins and Jacqueline Oakland. They're both phenomenal agents on my team, and they bring a lot of great, not only knowledge, but a day-to-day, hour-by-hour understanding of what's happening. They're out there on the front lines with our buyers and sellers every single day, and they've got a lot of great feedback. We've got a big data set between the two of them, and I'm excited about that. Stephanie and Jacqueline, thanks for joining us today.
Thanks for having us. It's great to be here and chat buyers and the buyer market.
Yeah, so last time we did a webinar, we talked a little bit more about sellers, right? We talked about how sellers should operate in this market, and we made some nods to kind of how to adjust as a buyer. But I think that what's been happening in particular lately have given some buyers some opportunities that we haven't seen in the past. So let's get to that. But before we go into how people should operate and what a strategy should be, I think it's fair that we take a few minutes to recognize what the experience of a buyer has been over the last 6 months, 9 months, et cetera. And it's, the graph that I show here is the traditional buyer's market, seller's market graph. And this is really defined in, hey, we feel that a balanced market in general in real estate is about 6 to 7 months of inventory. That means if no new homes come to the market, we sell through those homes in about a half a year. And really, since about 2013 or so, it's been a seller's market. We've had a lack of inventory, and it's been exacerbated by COVID. COVID was a pandemic that we really didn't see coming. And what it did, and we talked about this in our past ones, it was the great accelerator. Anyone that wanted to make a life change made that life change. And it involved a lot of real estate, especially in desirable move-to markets like Bend. And, they've been struggling to find homes on the buyer side. We're down to about 2 months of inventory, which is a very imbalanced market. So while I'm saying there's buyer opportunity, this has really been the buyer experience for the last couple of years. And the last year, it's been even tougher. And the other thing is that inventory continues to fall. So this is a graph of showing average months of supply. And this wave here shows that we were between about 5 and 6 months of inventory, 2018, 2019. And then into 2020, it just fell off a cliff. And this was really COVID. You can see when COVID happened. You can start to see that in January, February of 2020. And we didn't get our normal supply of inventory on the market. Even though people wanted to move here during the pandemic, no one wanted to have their house for sale. They didn't want to have strangers in their house walking around. They didn't feel it was a safe time to sell. And then it's only been exacerbated by all the buyers that have come on the market, and they just ate through what inventory there was, and we just continue to fall. So normally this is, we see inventory starting to climb every year in January, February, and this year really just didn't exist. That's what we're seeing. And what's the end result of that is a dramatic increase of prices. Back in 2018, this is the median sales price in Bend was about $400,000, just shy. And last year we saw it was about a 30% increase to $620,000. That's very uncomfortable for us that live here and know employers that are trying to hire people and struggle too because their employees can't afford a house. or, workforce housing is in short supply, et cetera. But this is the buyer's experience of what they've been feeling the last year or so. And it really shows up in this data. And this is a graph saying, hey, percentage of respondents who say it's a good time to buy. In June of last year, 61% of people said, hey, I feel pretty good about buying. Even though it's a pandemic, I feel pretty good about it. And that's dropped to about a third. We're at 35% for May. And my gut feel is that June would probably be even a little lower than that. I do think that the last couple of weeks, we've started to see the change that we're going to talk about here in a bit. But this is the buyer experience that we've been seeing. And so buyer fatigue is real. And Jacqueline, Stephanie, please jump in here. I'd love to hear, kind of firsthand stories and talk about some of these points that we have up here of what the buyer's feeling right now.
Sure, Brian. I would say that buyers who have been in the market actively offering in the past 4 to 6 months, are going to really have that feeling that, they've been unsuccessful. In some cases, they've had some heartache, they've had some loss. And now that we are in the months June, July, we're in the summer months, people are finally getting vaccinated, children are on summer break, families are finally able to start taking vacations. I think we're starting to see that buyers are getting to be more successful now. There is an opportunity for buyers to get in there and not have such a competitive experience.
Yeah, Jacqueline, do you have anything to add to that before we head forward?
I think that's a really great point. I definitely, and in speaking with other brokers, even around the country, I think that this time last year, we were seeing, after lockdown kind of let up, everyone was deciding, hey, I don't want to live in a big city anymore. Hey, I, can't do anything but look at real estate. And now with the vaccines, people are traveling, and kind of getting back to those day-to-day activities. So what I see in buyer activity is that we're starting to see a little bit less competition. And I think it is because people are a little bit more mobile. And so I think that kind of allows this opportunity that maybe wasn't there last year or even in the last couple of months, where if there are, 50 potential buyers for this one house and maybe 10 of them even are away for the weekend or out of town, or their kids have a baseball game, or things that weren't happening last year, you have this opportunity to be the buyer that gets the deal if you still stay on the market, and you still kind of keep an eye on inventory.
Yeah, no, that's a good point. I mean, a year ago, no one had anything to do but try to buy a home. And I don't mean to be deaf to the struggles that people had in last year, but in our world with our clients, there was a lot of people that were trying to solve their life through a real estate move. They were trapped in their houses, they were trapped in their condos, they were in a job they didn't love, in a place they didn't love, and real estate was a fix. But now that that the vaccines have come out and people are feeling safer and they can go take a vacation and take off the mask, we're seeing that panic emotional buying of, hey, I'm going to fix my life through a real estate purchase. That's largely in the rearview window. I still think that the fundamentals of why people are wanting to move here are still going to happen. Mass adoption of remote working. I think all those things are going to continue to push demand on markets like Bend. But I think the market has taken a little bit of a breather on that demand. So,
and I think you make a great point too, Brian, that I think we're getting back to the fundamentals of real estate buying in Central Oregon. Yep. For people that want to live here, that have families and housing, or even investors, but getting away from the pandemic buying.
Yeah, I think the pandemic related purchase decisions are finally in the rearview mirror, and this is great. I've been waiting for this. I don't like illogical buyer or seller behavior. It's hard to track. It's hard to advise clients on how to make smart decisions. And I'm glad that it is calming down. It's going to allow buyers and sellers to make more logical real estate decisions. So with that segment, let's go ahead. This is forecast. Let's talk forecast. What what's the market going to feel like here as we enter the second half of 2021? The Zelman's June broker report said this month's overall home buyer demand rating equaled 86. That's down from 88 last month, and it marked the first sequential decline since November. So really, in the last 9 months, 10 months now, this is the first month over month decline in home buyer demand. We were just talking about that, but it's measured now. It's not just anecdote. And what does that result in? This is a month over month increase in inventory. So this is, I think, the other main factor that we need to hone in on a little bit, because despite the fact that the months of inventory and supply are continuing to fall because we have pent up buyer demand, we're starting to see a light at the end of the tunnel for the buyers, and we're seeing homes come to the market, and they're coming home to the market later than usual. Usually our inventory supply grows in March, April, May, June, and then starts falling. Now we're starting to see it grow in June, July, and I'm going to project that we're going to see that continue to climb in August, September, November, into a time where usually that inventory falls. And we're starting to see that here in Oregon, or nationwide, or in Oregon statewide. We're seeing an increase in inventory 18% month over month, and that usually doesn't happen. Jacqueline, Stephanie, are you guys seeing that in the front lines as well when you're out shopping with your buyers?
Yeah, I am. I'm seeing more inventory come on, but in general, I think we're still at a record low inventory, and I still do think we have a bit of an inventory crisis.
Yeah.
But with that being said, I am seeing, more homes come on the market.
Yeah. So
Yeah.
Oh, go ahead.
Oh, every week. Yeah. We have, our local MLS, we have more homes listed for sale. And we are now, there are fewer homes going pending, more homes coming to the market. So it looks a lot healthier from our perspective. There's more opportunities there for buyers. Still, as Jacqueline is saying, record lows in inventory, but definitely feeling a little more healthy.
Yeah. So it's embodied by these three quotes that we were able to put together, from chief economist of First American down to the chief economist of NAR. And they're saying supply is expected to improve, which is to give buyers more options and help tamp down these record high asking prices for existing homes. Since I've been selling real estate, we've always averaged sale price to list price between about 96 and 98%, maybe 99% of list price that the homes would sell out on average on a great year. We're up at 105, 106% of asking price right now. And that's uncomfortable, that's imbalanced, and that's showing a dramatic shift. And I think that's stopping right now. So I think that we're going to create some buyer power that didn't exist in the market for the last at least year. Senior economist at realtor.com said the improvement we saw in new listings from May to June shows that sellers are entering the market historically later in the season, which could mean we'll see home buying continuing into the fall as buyers jump into new opportunities. So this is going to be an odd market. I think we're going to see an inventory that is going to help satiate that buyer demand in the fall, and that's not a normal sales season for us. So it's going to be an interesting year to see this play out. I certainly don't think we have a surplus of listings coming to the market, because nationwide, we've talked about this in our other webinars, nationwide, especially Bend specific, there are so many hurdles to new development, new construction, building permits, impact fees, et cetera, that really have just throttled builders and their ability to meet that supply. That for the last 75 years of real estate, there was supply, they met it with, there was a demand, they met it with supply. We don't have that anymore. We're short a couple thousand homes a year in Bend to meet the need to avoid these high prices that outstrip, living wages. But we are primarily getting it through what I'm now classifying as discretionary sellers. These sellers that have been attracted by this activity, that want to move into that next chapter of their life, upsize, downsize, move to the desert, whatever it might be. I think these discretionary sellers are going to be the primary driver of supply this fall. Jacqueline, Stephanie, are you seeing that on the front lines?
Yeah, and I just heard you say something about new construction, and I think that that it's really important to touch on that, because I've had a lot of people ask me, with all this new construction, will that be a flood of inventory? But I think it's important to remember that a lot of times builders will pre-market, so they'll show, you know, photos and information of a home that won't be ready for maybe 10, 12, 14 months. And we see a lot of those have been pending in the last 2 months, 6 months, a year. So it's not, you know, anything that's pending is not our inventory currently because it's essentially already spoken for. But I agree about the discretionary sellers as well.
Yeah, and to speak to that, I mean, where we stand with building permits, we're still only about half to 2/3 of the building permits that we had in the early 2000s. And that's coming off of 8 or 9 years of almost no building activity. So early 2000s, Bend, Oregon, we were building 2,500 to 3,500 homes a year. Down in the recession, 9, 10, 11, 12, we were building 300 homes a year, 500 homes a year. And now we're still only back up to about 2,000, 2,500 homes. And we have very little entitled land out ahead of us. We did our urban growth boundary expansion, et cetera, but infrastructure hasn't caught up to that. The prices are stopping the builders from being able to develop. But I don't think we have a flood of new construction coming. I think what we have coming out the door is being sopped up right away. And the builders are also struggling, and everyone's saying, oh, the builders must be making a ton of profit. And yes, they may on that one sale, but as they go to replace that land and try to build the 2022 and 2023 homes, the increases in the lot prices have gone up so much that any profit that they're making on these ones is all being dumped right back into land replacement. So they're on a bit of a treadmill as well. So I don't think we have a builder flood of new homes coming. While we may see a lot of activity and cranes in the air and trusses going up on new houses, it's still nothing anywhere near what we had 15 years ago in Bend.
Ryan, and I would say it isn't enough to meet the demand of our buyers. So we just have a backlog of buyers in the market. So we do expect for the selling months to extend into the fall and winter.
Yep. And that's a good point. And I may be berating this point, but this is new listings. This is the cause for hope. And this is that discretionary seller coming to market. So this is about a 2-year graph showing that in the last year, we're up 26% year over year in new listings hitting the market. So when we cross the new supply, supply and demand, I think it's going to be a while. So, but there is some hope for an increase in new listings. This also showing up in that flagging inventory or the flagging buyer demand. Nationwide, showings are actually down the last 2 months in a row. So I think a lot of this goes back to what Jacqueline was talking about. People have gotten on with their lives a little bit. They're back in the office. They have to show up at work, or they're on vacation or whatnot, and buying. It seems like, it was a Zillow pandemic as much as anything, where people spend all their time on Zillow shopping for homes. But now we're starting to ease off on that just a little bit. Now, I think the thing that we need to talk about, and I think the elephant in the room for a lot of people is saying, well, hey, these prices went up fast and they went quite high. Is it a housing bubble again? And I think we need to talk about that. And let me just start with this quote, and then I think let's open this up for discussion. And then I'd also love to see any notes from any of the people here that have logged in. But this says these outsized increases in pricing have raised concerns that a home price bubble is emerging. However, conditions today are quite different than in the early 2000s, particularly in terms of credit availability. The current climate housing prices instead reflect strong demand amid tight supply, helped along with record interest rates. So it's a very different environment that we had in 2007, but it still begs the question. Stephanie, Jacqueline, are you hearing this concern from your buyers on the front lines?
Yeah, I would say people are always asking about it. Is it another bubble? Are we going to relive what we've been through, a decade or so ago? And I would say it's a very different market at this time. I mean, especially with the competition we've been seeing. I mean, cash buyers are out to buy, with cash. I mean, we have very strong buyers. We have people putting more than 20% down, just to be a really strong candidate for a purchase with financing.
Yep.
Underwriting is strong. You have to really meet the requirements. So I would say it's definitely a different market. We have a lot of strong buyers in our marketplace. So
I would just add to that that it is a concern I hear, and I think that the biggest thing is that it's a completely different issue this time around. It's an inventory crisis. So we all remember what it was like trying to find toilet paper or a mask in March 2020, right? So it's like that with housing now. There's just not enough to go around. And as of today, in Bend, there are 413 homes pending. So that's single family homes in 977, 01, 02, and 03. And active homes in those zip codes, there are 270, which shows that there are still more homes spoken for under contract than there are available to buy. So I think that that's, data that we just need to consider. It's great that there are more listings coming, but it's still a tough market for buyers.
Yeah, and I think, those are great points. And if we're to want to speak specifically to the word bubble, we've done seminars in the past, and maybe it's time to address them again. But we've done a hard data analysis on what happened in the early 2000s, and it was a very different situation. The lending back then was much looser. They were lending to anyone with a pulse. And I think the other big part of it is that speculators and investors were such a big part of that bubble. And we just don't have that today. We're starting to get some second homeowners and investors back in the market, but it's still a minority. Back in 2005, six, people were buying 4 or 5 homes. They were buying them 95% loan to value, 100% loan to value. They even have negative cash flow. They didn't care. It was all based on speculation. And this one's different. We have such a lack of supply that it's going to be hard to imagine a scenario with big enough, a big enough trigger to pop the housing prices in a significant manner when we have so few homes. And this could go into the bigger discussions of the macroeconomic factors of the millennials are all, coming into their peak buying years. They're all having kids. They want to buy houses. And they're a big factor now, and we need to meet that demand. And so it's just a very, very different scenario, but we have one specifically on that in our past webinars, which we can send in the links at the end of this, but I think it's worth talking about. But let's go on. Another quote here that I think is relevant is home buyers. This was from JP Morgan. Home buyers, interest rates are still historically low, though they are inching up, although they came back down a little bit recently in the last week or two. Housing prices have spiked during the last 6 to 9 months, but we don't expect them to fall soon, and we believe they're more likely to keep rising. If you're looking to purchase a new home, conditions now may be better than 12 months hence. So let's talk about that. And let's talk about interest rates and how that affects the purchase and why we still feel, home buying right now is not for everyone right now. I think this is where your decisions need to become more nuanced. You need to make sure it fits your strategy. But if you're a buyer right now, why do we still feel it makes sense, especially in this interest rate environment? I don't know, Jacqueline, Stephanie, do you want to take a stab at that?
Yeah, so I saw, interest rates are still historically low. They are projected to increase. I saw an email today that the average for 2021 is around 3.1%, and 2022 will be around 3.7%. So if that, a little more than half of a percent, that over the life of a loan, 360 payments or 30 years, that really adds up. And your buying power is, I think, one of the most important things to look at when you think about purchasing a home. So you don't want to just look at the numbers. Could I potentially buy a house for $50,000 less in 2 years or 5 years or, 10 years ago? Those interest rates affecting your monthly payment, that's huge.
Yeah, I mean, a 1% increase. I mean, we've run these tables before and maybe we need to do it again, but an increase of 1% at this point is an increase in your interest payment, 33%. So, who cares if your housing prices go down $50,000 a year from now, if your interest payment, your monthly payment goes up by a third or a quarter. So it's one of those things that unless you're a cash buyer, flipping houses, which is not the type of buyer we represent. Unless you're that, interest rates play so big into the home buying decision that it's one of the things that still makes, provides support for a logical purchase in this market. Let's go on just a little bit. So this was a home price expectation survey that was a survey of economists. And what they're showing is none of them showed negative price in the next 5 years. The consensus was that 2021 was going to be about 8-9% in appreciation, and then it was going to moderate down. And to be honest, I think that appreciation has really already been realized in 2021. And then 2022, 5%. And then they're saying somewhere in that mid threes for 2023, 2024, 2025. So unless the economists are wrong, which they've been wrong in the past, nobody's seen a bubble pop ahead of us just because of all the demands that we have on our limited supply in this market. And macroeconomically, the economy is doing well and should continue to support that. Obviously, big macroeconomic factors, corrections, et cetera, can play into this. But I think we need to understand that the home real estate industry or economy has always been kind of, its own animal. It doesn't respond to recessions. And for the last 6 home recessions, home prices have gone up. It really beats to its own supply and demand and interest rate drum. And what we're seeing right now shows continued support the next couple of years.
Yeah, Brian, we did get a question. It says, can Bend sustain the $400 to $600 per square foot housing cost? That's more concerning to me than a real estate bubble or interest rates increase. What are your thoughts on that? How are we looking for price per square foot?
So it's a big question. It's a good one. Should it sustain it? No, it's a problem. And I think that's going to be one of our biggest limiting factors to having a healthy economy and a healthy town for the next 10 to 20 years. And until we get a grasp around this, of meeting that through some growth, and I'm not a big unbridled growth person. But we have to say, if we want to keep the door open for other people to join us here in Bend, Oregon, and we want to have affordable pricing, some of that can be done through workforce housing, and the city's doing a lot of great things. They just brought in a piece. This new city council's awesome. They just brought in a piece outside the urban growth boundary, got the state legislature to railroad it through. It's going to bring in a bunch of new housing in Southeast with a quick timeline, and a majority of it has to meet, the 60 to 80% of our median wage, and they're going to do all kinds of great things. But really, in the big scope, it's supply and demand and macroeconomic forces, and we're going to need to have some supply. So to answer that question specifically, it's going to be a struggle, and it's going to be a struggle, and it's going to show up in the cost of restaurants and the cost of everything, because they can't afford to hire employees that have houses. And what I'm afraid of is, unless we start meeting this head on and start building more than 2,500 homes a year, we're going to become a lifestyle town that isn't holistic. Our teachers, our firemen, firefighters, are the people that answer the 911 calls, are going to be commuting in from other communities to serve Bend, but not live and be part of it. And that is one of the things that I'm hugely concerned about. Whether that creates, that problem undermines the value, I don't think it does. So unfortunately, I think there's enough lifestyle buyers, enough wages that have come in with all these new industry that EDCO has helped bring in, from biotech to pharma to outdoor, retail type of stuff. We have a very diverse economy. This is Bend 3.0. This is nothing like Bend in the 2000s. This is nothing like Bend in the 80s. And I think there's enough demand that's going to hold up these prices, to be honest, in long term. So I don't think just because prices have gotten high means they're coming down, unfortunately.
Mm-hmm. We had another question, is how is Bend addressing the inventory crisis, and are they allowing more permits? So you just spoke to most of that, but I think the question about are they allowing more permits is an interesting one. And I think we've addressed this on a previous webinar, but there is some multi-purpose housing, and different things in kind of in the Midtown area. And I can direct you to the that webinar if you'd
Yeah,
like.
it's the future of Bend, whether we like it or not, is going to be different. It's going to be denser, and it's going to be vertical. And if we don't like those terms, then Bend may not be right for us. And it just is, because the Oregon land use laws that were put in place in the 70s, like urban areas and they like rural areas, they don't like low density urban sprawl. And that's why Oregon is the way it is. And that's why it's pretty. And we see endless forest right up against the border of Bend. But the land use laws support densification of cities before growth. And so the city is doing some pretty creative things. They're upzoning. They're allowing multifamily in what used to be single family zoning. They're doing expansion of the urban growth boundary. They are upzoning that whole, and I think you just touched on it, that central area between the Parkway and Third. That's their vision, that central redevelopment district, up to 7, 8-story buildings, mixed retail, employment. In a lot of ways, it's going to be really exciting. But I think the picture of moving into Bend and saying everyone gets a single family house on a 10,000 square foot house that's only 5 minutes from downtown, I think that ship has sailed. That is now a Boise. That is now another type of town that's going to allow that low density sprawl in all directions. And it's not Bend. So they're trying to meet it. The difference is that it's going to be our perception of what's housing, and how those first couple rungs on the ladder that used to be straight into a production single level house now may be apartment, condo, townhome, loft, then to single family. It's going to be a very different property ladder than what we've experienced in the past. And it's part of becoming 100 to 150,000 person city. It's just very different than a 50,000 person. So it's growing pains. And so they're trying to meet it as best they can within the framework of the Oregon land use laws. The city hears it. They're yelled at all day that they're not providing enough opportunity for housing. And they're saying, hey, what else can we do? We're putting in sewer and we're putting in water and we're fighting to expand the urban growth boundary. Part of it's just growing pains. And also now that the economics have gotten to the point where they are, now it makes sense for builders to get big money. This isn't, going buying and entitling 10 and 20 lots. This is going by city blocks, taking out low value commercial and going and instead of doing a $5 million development, it's a $50 million development, a $100 million development. And the economics have now attracted that. So the next decade of development is going to be very different than that traditional single family sprawl. It's going to be up. And like it or not, that's where we're going.
And if you're a viewer and you want more information on the specifics of this, urban growth boundary and opportunity zone will be your opportunity zone in Bend. Those are your kind of keywords for your Google search to find more info on that.
So we've kind of gotten long-winded, and I want to be cognizant of everyone's times, and thank you for joining us today. But okay, who wants to take a crack at that? Should I buy now? Stephanie, do you want to talk about this, of how it fits into someone's strategy?
Yeah, I'll just say in general, for starters, should I buy now? Should I sell now? That is a question we get a lot. And I would say in general, you have to do what's right for you and your family, whether it's now or later. You can't time the market. You just have to do what's right for your needs. So in terms of risk mitigation, for example, interest rates are still historically low. We may have seen rock bottom, recently, a few months ago, but we only anticipate them going up. It sounds like they're going to be creeping up this year and next year. And then, we have seen amazing highs in the past years. So markets are very different now than they were in the early 2000s. We don't anticipate it to be a bubble that's going to burst, although we've had a rocket trajectory in pricing and values. We do anticipate that to kind of temper down a little bit and not be quite such a high jump as we've seen in the past few months. Plan a strategy session with your local real estate broker. Get an expert on your side to help work with you and talk you through what's right for you. Time in the market, we think is more valuable than timing the market. So just having your equity in the market and allowing it to grow there is really important. And then the broader market, of course, we've mentioned this many times. The millennials are aging into buying homes now. You know, we're seeing it, you know, working with our buyers. We have many young people, many young couples buying homes here in Central Oregon. So they are aging into the market, and we're going to have a huge influx of those across the nation and locally in the next few years. So right now we still have historic lows for interest rates. And then we are anticipating lots of millennials coming to the market soon. So, you know, if you are at a place in your life where you are hoping to buy a home, I would say this is a great time to do it.
Yeah, as crazy as that sounds after the experience we've had in the last year or two. And we're not saying that there's never going to be price corrections. And we don't believe, and we're not saying that there might be segments of the market that have been overheated. In particular, you know, that narrow segment of the emotional buyers, the ones that were escaping the city, that wanted a vacation home, thought they could work remote, may have to go back to San Francisco or Seattle in the coming years. I do think there's a few parts of the market that are going to be more disruptible than others, but we don't feel like we're sitting on the top of the big frothy bubble. So yeah, that was great. And I pulled up this quote by Nick Murray. He's more of an equity stock advisor than real estate, but this quote is appropriate. Timing the market is a fool's game, whereas time in the market is your greatest natural advantage. And I think it's as simple as that. And we need to get back to the fundamentals of why people own homes. You know, is it an investment flip? Hey, your primary home should not be an investment strategy. You know, it should be part of your overall strategy. But it's going to sound crazy coming from me. Your primary residence is not an investment tool. It could be an asset, could be a liability. It can be part of an overall investment strategy. But the primary motive of owning a home is security for your family, for you, for allowing you to build a career and family and life experiences. And we have to get back to that. When you start purchasing investment homes and you start doing, you know, shorter term holds, things like that, it does become more of an investment vehicle that involves depreciation and opportunity zones and tax strategies and all that. And we can talk that language with you as well. But for a primary person that's owning a home, we need to get back to the basics of why they're owning a home and how they can make a logical decision that weathers whatever, you know, whatever cycles that we go through. And let's get to that. So let's say someone does want to buy a home in this market. Jacqueline, how do they make that happen?
Yeah, so like Brian said, you know, we're here, we're your trusted experts, and we would love to help you, whether it's now or a year or 2 years from now. But if it is now, what we're seeing is that while we might be seeing some more inventory, we might be seeing fewer competing offers. So a few months ago, you might have been up against 8 or 10 or 12 offers, and maybe now it's 1 or 2 or 3. There is still low inventory, there is still competition. So we want to make sure that you are positioned well for, you know, the best possible outcome for you and your family, which is getting the home, without having to overpay, without having to leverage yourself more than you want to. So with that, you know, come prepared. Make sure that you are knowledgeable about the market, about the inventory, have your pre-approval letter in hand. I also suggest having a proof of funds. So whether you're putting 10% down, 20%, 50%, go to your bank. It's super easy. Go to your bank and ask them for a 1-sentence letter saying, you know, John Smith has proof of funds in excess of, and then put that 20% down. So your proof of funds letter and your pre-approval letter, those are free for you to get. They just take time, right? Time and energy, but they will definitely put you ahead of the competition who do not have those letters. Strategy ready to shift in buyer seller control of the market. So with this, I would say we don't ever want you to overspend. If there are no other offers, if you're the only offer on the table, take all your contingencies and we'll write a strong offer. You know, you'll have your inspection, your appraisal, your loan contingency, financing. But if we are talking about multiple offers, we need to start talking about, you know, at the end of the day, the seller is going to be looking at how much can I sell my home for? What's the guaranteed amount and how quickly? So when you have a loan and you have an appraisal, if you can think about waiving some appraisal, you can put a cap on it. And this is kind of a longer conversation. Feel free to ask questions about this, but essentially it's saying in this market that's kind of volatile and it's been going up so quickly, appraisers are trying to keep up. And if you're in contract for a home that's $500,000 and it appraises at 490, can you make up that $10,000 difference? Can you tell the seller, hey, in advance, if this appraises 10,000 under, I'll put that extra on my down payment rather than ask you to price drop. In addition, an inspection and as is inspection contingency is something I've been suggesting that a lot of clients consider. And that is where you would essentially say you still have your inspection contingency. So we'll still always suggest you get a licensed professional to inspect the home, make sure that everything's running and good with the home. But hey, let's shorten up that contingency period. So rather than 10 business days, a seller will know after 6 or 7 business days that you're ready to go, that you've accepted the home in its condition, that you are going to accept any repairs, and that you're not going to ask them for a price drop. You're not going to say, I want dollars off of the home. So really understanding these ways to strengthen your offer will go far in this market. And the other thing is a seller rent back or knowing the seller's timeline. And that is our job as your real estate professionals to, speak with their agent and really understand, hey, are they moving out of town? Are they moving in town? Do they need a few days or weeks or months of rent back? What is their situation? How can you make that as easy as possible of a transition for them? And I think that that is one of the most important ways to really write a strong offer. And also one of the ways that won't cost you extra money. Would you rather give them a week of free rent back or spend an extra $15,000 in your offer?
Well, yeah, Jacqueline, I've seen a lot of success with you and Stephanie this year where on properties that received 5, 10, 15 offers, you were winning them. And it wasn't necessarily just being blind with dumb price increases over asking price. It was really about meeting the seller needs. And it's always surprising when we list a property, we'll get 5 offers and we receive 0 calls from their agents. They don't even know what our seller wants, but besides their price. And so they're just blindly guessing and they're doing these escalations and throwing these big price increases when that's not necessarily the driving factor of the seller. The seller may have another house that they're building or buying, and they need to get this closed and the money in the bank so that they can have security and not own 2 homes at a time, or they may need to rent it back for 30 days while that other home's being finished. There's so many details, there's so many factors as part of an offer, and it's not just about price. So that's where doing your homework up front and really understanding and interviewing the seller's agent, you guys have done a really good job with that. And you're certainly batting above, our client, when there's 20 offers, you're not losing, what is that? Yeah. 95% of the time, so you've been doing great in that.
And I would just take that one step further and say, when I see a couple of my clients on this, and I would say when we go and see a home, just for the first showing, what's the seller's plan? What's their ideal closing timeline? I come prepared with all of that. So if you are working with another agent, maybe not our team, hey, are they giving you that information on your first showing? Because that's really, really valuable in this market.
Yeah. And I think the other thing is there's ability for buyers with loans to be successful that they weren't 6 months ago. When there was 5 offers on the table and 1 was cash with no contingencies and they'll close in a week, you didn't stand a chance, right? Mm-hmm. But now that it's come around, softened a little bit, there's a chance to buy homes with loans these days, right?
Mm-hmm.
Absolutely.
So there are other ways you can strengthen an offer. You can release earnest money after inspection contingencies. You can share closing costs. But I think that, without getting too far into the details of those, the bottom line is that we are here to support you and we can talk through all of these details. And the takeaway is that we want you to succeed without having to overpay or without we want to keep you protected. We don't want you to release earnest money. We don't want you to pay more than you have to. So we, have an eye on this market and all the other offers that may be coming. And we'll definitely guide you to the best possible outcome. So
So I think we can, give our buyers permission to go take a deep breath, have a glass of
Mhm.
wine, and go take a run along the river, because there is opportunity. The panic is in the rearview window. And I hope, I could be wrong on this one, but certainly all indications are showing that it's becoming a healthier, more balanced market where you can make logical buying decisions. And this is time to re-engage. This is not, what I'm afraid of is that this is a time for buyer fatigue and people are going to give up at the wrong time. And I think these next couple months have another window of opportunity to be successful. And that's why we're here and trying to get the word out. So thank you all for joining us. Thank you, Stephanie. Thank you, Jacqueline. And if anyone has any questions, you've got our email, send us an email, send us a text, whatever, and we'll be happy to catch up.
Thank you.
Thanks. Have a good day.